I wanted to answer the question, what is Lemonade worth today? What could you argue that present value of Lemonade is based on its future profits? And this was inspired by Matt Smith, tweeted this out or posted this on X, that he's seeing a present value of the stock of $192 now. And he goes on to talk about how loss ratio is dropping. That's improving their LTV to CAC. And I was playing with my own model, and I could definitely see how you can get a present value of something like $180 a share, and even argue maybe it's worth even more, $250, $300 a share. So I wanted to give the background for the analysis that gets you at this number. So in my Lemonade model, and if you want to join my Patreon, that's pretty awesome. There's like getting close to 200 people in there, which is pretty wild. If you want to join that, you get full access model. It's only $5 a month, and continue to update it, improve it, and update it each quarter. So what's happening here, and if you think about some of the key inputs and what we could potentially change, is the loss ratio. I've trimmed my sort of future steady state loss ratio down. That was a major change. I think I had this at like 65, 66, 67% gross loss ratio. And I'm having a gross loss ratio more like, 60% loss ratio in Q4, because management actually said in the earnings call that, if there's no major cat events, that they anticipate a new record for Q4 for loss ratio. So that's dipping, but then I have it lower, and then at some point, I'm expecting maybe they pass on some of those savings to the customers, and you get improved, you have marketing efficiencies that continue to scale well as they spend more and more on growth spend marketing. But so that's a really key metric. That's a key variable, and even the topic of the loss adjustment expense that Lemonade brought up in the last earnings call, which is just basically the portion of your losses, the percentage of your overall premiums, or a portion of them that's used for checking on fraud, administrating claims. And I made the point here in this Twitter post that, going to 7% to 3.5% is huge, because a lot of insurance companies have pretty small, tiny profit margins. So if you could, 7% is already amazing, and if you can cut it down another 3.5%, you can move that straight to profit, which is a lot in the long term, or to customer savings, improve growth spend return. So it's pretty wild you think about that. And I asked Grok, what is typical for P&C insurer, and they said it's more like 8 to 12%. And Matt here asked, well, what if you do get to 3%? That would be insane. He said, yes, that would be very impressive. So what I'm thinking is a portion of that could be making your gross, your loss ratio even in smaller and making your company more profitable. Then a portion also could be passed on to customers in pricing your policies more efficiently, or with a better price than competitors, and you get much better conversion rates in your marketing dollars. So that's the way I'm thinking about that. And then of course, outside of the loss adjustment expense, Lemonade will continue to more effectively pick the right customers and match the rate to risk. Yeah, so the gross loss ratio, I think on an overall average, obviously there's going to be quarters where they're 59% and quarters where they're 70%, but as a whole, I think going 64% sort of in a steady state is not a bad idea. I have my top line growing at about 30% all the way out to 2033, doing basically that 10x of where they were at Investor Day last year, going to the 10 billion mark at the end of 2033. And within that, I assume they're going to be able to do that, and then I work backwards to say, well, what is it going to cost them in marketing spend to get there? And so I use I have my sales and marketing growth spend will continue to grow. I have $200 million spent next year. I have 180 million this year, 269 million year after, 313. Like that's going to keep growing as you spend more and more, and just to maintain your book of business as people churn away, plus also to continue to grow. And then I have a conversion ratio of how many dollars you spend on customer acquisition, gross spend, and converts to IFP. And they've been, you can see they're 2.7, 2.37, 2.56, 2.5. I have next quarter. And then I think as CAR expands and they expand even more countries, more places, you could continue to ramp up that growth spend, and maybe you even pass on savings to the customers more aggressively and continue to pass those on as well. Then you get down to, that's why I'm keeping a sort of overall average marketing conversion of 2.65, and that just carries on through all the way to 2035. So those are really key variables: what you're going to put in for your loss ratio, what you're putting in for there. I also work out based on how the products could grow way down here in terms of each product line, how it could project in the future, and as part of that can get an annual dollar retention kind of going into the high 80s. I mean, if CAR really ramped up suddenly, they could go even into like the 90s, mid 90s, but I just have it in the high 80s out again, sort of as a steady state number as they over the next number of years as they grow. And then the other major one to look at is I have operating expenses minus growth spend. So all of your operating expenses minus growth spend. We're at about 95 million, this last quarter, and I have, as a year-over-year change, a bit of a lumpiness over the next couple of years, but then as a sort of steady state, I have it growing more like 4.5% per year. So growing out, to the end of 2032, we're at 119 million. 125 million. This is all your expenses to manage the business outside of what you're spending on your ad spend, growth spend to grow the business. So there's some really key variables that flow into that, and then from that I have like the way I'm doing my evaluation. I say, okay, I have a 2032 PE of whatever you want to put in, and a 2030 P5 PE of whatever number you want to put in on the earnings per share those years, and then have a certain discount rate. So I have thrown in 10%. Maybe you think 10% is too low. You could definitely go higher if you want. I mean, it's more about an idea of like, what is the value of a company worth? You can think about that in different ways, right? You could think, maybe it's worth $180 a share right now, and even at $180 a share, I'd still earn 10%. So maybe at a 10% discount, you could think maybe I buy, maybe it's a good deal up till half that. Maybe a good rule of thumb. I was explaining this to a friend today that maybe a good rule of thumb is like you have some level of confidence in the price being worth $180 today, and maybe that gets you like a 10%, even return at $180 out, the next number of years to 2032. But maybe you feel comfortable buying shares up till sort of half of that amount, and because obviously we're not buying them at $180 a share right now, but maybe you feel comfortable buying up to, $90 a share, and half, it kind of leaves you like a 2x sort of factor of safety behind what your sort of your present value you've worked out to be. You could think about it as you adjust your discount value to something much higher, like 25%, and say, hey, I have to make 25% a year if I really want to invest in this company. And you say, well, if I can still buy shares like today at $71 a share, I think based on my modeling, I could make 25% a year up till 2032 on that. Or of course, you could argue maybe you don't do as well as that and you only make 20% a year. Well, that's still fantastic. Or maybe you think, there's actually even upside beyond some of the variables I looked at here, which I think there could be, and the way the market's going to value them in 2032 might be higher, like than a 40x multiple. So you can kind of think about your discount rate and what you're sort of willing to pay for something in that regard. But I'm using 10% discount rate. I'm looking at 2032, and I'm saying, look, 2032, Hold on here. 2032, if I scroll up to the top of my model, I have only $7.5 billion. Like only $7.5 billion of IFP in a ginormous, insurance world pool that's still growing. So I actually think this is kind of conservative on the. Some people might say, wow, that's way too high of a P ratio, 40. But if they have some of the very best margins and they're proving they continue to grow, and you're only $7.5 billion, I think like this could be nutty. Like this ratio, P ratio could be way higher. The market might say this is 100. And things could go crazy. You could say it's worth $450 a share right now. And that's where you can kind of see, as people do the math over the next few years, things could go. I will not be surprised by anything. Nothing will surprise me. I would not be surprised like in a year from now, we were at $300 a share. Like, would not surprise me. And you can kind of make the argument it should be, because maybe you're only at $7.5 billion in a multi-trillion dollar, and growing insurance world. And so, yeah, you have all the room in the world to grow. So you should be way higher than, 40x multiple. And then if you project out further to 2035, so based on the 2035 numbers, I have 2035 of like 14.5 billion of IFP. So even that's still relatively small, and even compared to insurers today, it's pretty tiny. And I'm putting a 30x multiple on it. And this is also with like a net income margin. You could look at that. It's just 2032 net income as 12%. And then 2035, I have it going up to like as high as 17% right now. With that's higher than I had it before, just because the loss ratios. If you can have such effective loss ratios in pricing and such lean loss adjustment expense, like why? If they can get to 3.5% loss adjustment expense, maybe they can even get to like 2%, 1%, and you're continuing to shave off those digits, and then the dollars flow right to the bottom line or back to your customers in more effective growth spend, marketing spend. So so all that's how I'm thinking about it, and that's how then you discount that back. You get $180 at a 40x multiple and a present value today. And again, if you think about like maybe a rule of thumb on a 10% discount is maybe I'm going to pay up to half of that. It's like you could mentally think about, I think Lemonade's probably still a really good deal up till like $90 a share, maybe, or even higher than that. You're probably still being a really fantastic investment over the next 7 years. That's one way you can think about it, right? And again, I would not be surprised if the market says, they deserve even a much higher multiple. And in 2032, again, this is like 50 multiple, then you can say it's worth 225 now, or this is a 60 multiple and it's worth 270, or like I showed before, like a 80, or I say 80 would be 300 and some dollars, or 100 multiples 451. So you can really justify that. And I wouldn't, if the market really catches on, they just keep cranking, like hitting a grand slam every quarter here, showcasing their numbers. Things, that you could just, I would not be surprised if it made a move, made some severe moves in the next year again, where we go from whatever $75 now to $150 to $300, and maybe even beyond that. As you go out even a couple of years time, and as the market sees profitability is coming, and then profitability is going to soar. So that's the way I'm thinking about this. Again, you can get this model on my Patreon if you want. I will be doing another video thinking about, Q4, like right now, give you a little preview of, minus $12 million adjusted EBITDA, and, next year of a couple quarters of profit, and nearly sort of just over break even, or around break even for the year. I think it's going to be really close. And anyways, I'll dive into that and save that for another video. But thank you so much for watching. Remember, it's in the bag.